Hi, everyone. I'm super excited to welcome our today's guest. He's the sole GP of engineering capital with asset under management, $150 million. He ran VMware ESX server and Silicon Graphics WebFORCE. He had invested in Azure Power, which went public on New York Stock Exchange. He was also the first investor in SignalFx, which was acquired by Splunk, led the seed round at Netsil, which was acquired by Nutanix. He's also the first Czech at Robust Intelligence, Menlo Security and Kentik. We are super excited to have him over here. Welcome to SheVC. I'm your founder and host, Gayatri Sarkar. So today we have Ashmeet Sidana with us. He is the Chief Engineer of Engineering Capital and the sole GP of Engineering Capital. So super excited to have him over here, Ashmeet, and welcome to SheVC.
Thank you, Gayatri. It's a pleasure.
Now, I'm so honored to have you because you have been one of the trailblazer, investor, and not only just in Silicon Valley, but I think in the entire US, the way you look at the market, the way you focus on technical insights. And I would like to take a quote from Wall Street Journal. You talked about your company and how you're investing. And I quote, you said, the companies that represent the largest, most well-recognized, best established technology to the IT ecosystem don't power the best data centers in the world. Those are run by Google, Amazon, Alibaba, and Facebook. So when you said that, I definitely feel that you saw there is a market need. So why did you find a market need exist? And why did you think to create Engineering Capital VC Fund?
Thank you, Gayatri. What a great question, because in venture, we have this wonderful luxury that our market is changing all the time. We live with innovation, we live in technology, and the pace of change has continued to increase. I noticed two divergent trends which happened to come together when I started Engineering Capital. One was a change on the technology side, which is what I was referencing when I gave that interview to the Wall Street Journal, where I had noticed that the data centers that were run by Google, Facebook, Alibaba were so much more efficient. You know, depending on which metric you measure, power, number of servers, number of system administrators, etc., they were 100 to 1,000 times more efficient than the traditional IT data centers. And so that was the market opportunity. I mean, anytime there's a dislocation of 100x, you know there's going to be a massive change. And so that was the opportunity on the technology side. And then at the same time, venture capital as an asset class was going through a dramatic change because of the fact that we had seen a dramatic reduction in the cost to start a company, and yet a dramatic increase in the total amount of capital that it took to take a company public. What had happened is these two opposing trends had ripped apart the traditional venture capital model. The traditional venture capital model was, you know, a $200, $300, $400 million fund. You became the first investor, and you were the largest anchor investor up to the IPO. And IPOs took 4, 5, 6 years. And companies took 20, 50, maybe $80 million before they went public. That would be a massive amount of venture if it went out. Well, because of these two opposing trends, you could now start a lot more companies with less capital, yet it took a lot more capital to go public. That ripped apart the venture model. And so it was clear to me that we were going to cleave, and there would be an opportunity for small boutique funds, funds like myself, or large platform funds, you know, like the established firms, Greylock, Sequoia, Excel, etc., who ultimately ended up raising, you know, multi-billion-dollar funds each. And so that was the two things coming together, which was the genesis of Engineering Capital.
That's great. You get me excited because someone like me who studied physics and math, and when you're talking about the basic of science and how you're investing, that is like so amazing. I would love to know, like, as you talked about this large funds, and then you talked about a fund like yours, and you're the first chick for a startup. So do you see further movement in the emerging fund manager space as funds like yours are becoming more like an institutional asset class? And do you see any changes also that has happened in the market opportunities in the last few years?
I think we are in a unique time in the evolution of venture capital as an asset itself. If you go all the way back to George Dorio and ARD and the very first venture capital firm in the world, which George had started, there was a model that he was practicing, which pretty much got established in what I call the traditional venture capital model, where there's a firm, there's a few partners, and they are life cycle investors in a company. George Dorio, obviously famously in the case of DEC, Digital Equipment Corporation, he made a tremendous amount of returns over there and
Yeah.
really established, what we think of today as our industry. Right now, we have a Cambrian explosion in the number of firms. We have seen the great firms become large platforms. We have seen the great firms, and I'll take Sequoia as an example of that. They've raised multiple funds, very large, different strategies, growth fund, early fund, etc., seed fund, etc. We've seen great firms which have doubled down on their own strategies, stayed true to course. Benchmark will be an example of that. We have seen firms like myself who are trying to innovate, who are trying to break the model in an interesting way. And so we're seeing a Cambrian explosion. We've literally had hundreds of micro VC firms get started. All of us will not survive. That's clear. It's clear that there's too much capital, too many firms, and we cannot support, the underlying companies don't exist to support that much capital. But frankly, that has always been true of venture capital. There's always been too much capital because it is such a seductive return when it works. If you can make it work, it is such a beautiful business to be in.
That's so true. And I feel like the world is changing and there's so much of capital now fueling the early stage investments, and that's helping a lot for late stage investors. Obviously you have the great Alan Turing in your office, and that gives so much of inspiration for people like ours, especially the nerdy science people, to look at this opportunity and say that, hey, let's change the world, let's put some more money into innovation. And I would like to go back to your past. You had ran the VMware ESX server, you were the director, you hired the very first employee in that particular vertical. How do you think that experience as a founder, as an operator, has changed your perspective? And you also ran your own companies. So how that helps you, when you are trying to work with your portfolio companies, because you are the first check. So that means you are doing a lot of groundwork. You're maybe helping them in hiring, you're maybe helping them in product market. So I would love to know that take.
So, this is something where people have different opinions in venture capital and people practice it differently. I come from the camp. I was trained by Catherine Gould, Jim Anderson, some of the luminaries, founders of Foundation Capital, people who really pioneered venture capital itself in very interesting ways. And I come from the school where I think the most important thing a venture capitalist can bring to investing is operating experience. It is the actual work that they have done in building companies, running companies, etc. And so investment experience itself is not helpful in practicing venture capital as a business. So yes, of course, I'm an investor, and of course, I run a fund, and of course, at the end of the day, I'm trying to return capital to my LPs. But this is not done through a spreadsheet. This is very different from what is done in public market investing, or even, for example, what Warren Buffett practices, right? He reads reams and reams of annual reports. He talks about the research he does, etc. I can't do that kind of research. I am investing in two people and an idea. When Azure Power walked into the door with me, it was one person with a 5-6 slide PowerPoint. And he said, I'm going to build gigawatts, equivalent of nuclear power plants of solar power. And I was like, man, this guy's insane. Like, how is he ever going to do this? And it's crazy. And, solar power at that time was a toy. It was basically things which people did on a charitable basis, on a feel-good basis. It was not a commercial endeavor. I want to make money. And so I sat down and had a heart-to-heart with Inderpreet, and I said, is this a commercial endeavor? Are we actually going to make profits? Is this going to return a high gross margin, long-term high growth business? And obviously I was convinced. Obviously I invested, and now, very proud to say that, that became my first IPO as a venture investor in terms of that. But what fuels venture capital
Mm.
is this innovation, this ability to identify a new opportunity because something has changed. In the case of Azure Power, it was Inderpreet observing the reduction in the price of solar panels, right? It was just this very clear trend that he had established, and
Mm.
everything else was cookie cutter. We just
Yeah.
put everything around that. And it was clear there was a tipping point coming. And once that tipping point happened, boom, it was going to be an explosion. And that's what we saw. Often we see that here, especially here in Silicon Valley, and certainly the area that I work in now, it's around software.
Mm.
Why software? Because software has this wonderful property that it has a zero cost of goods sold, right? It's completely free. Once you write that first, once it's actually developed and built, distribution, cost, replication, it's all completely free.
Yeah.
And so it has this magical property, or as Catherine used to say when I would chat with her about it, there are only two things in the world which have zero friction and infinite leverage.
Wow.
The only two things are money and software. They have zero friction. There's no friction if you have money. I mean, there are a little bit on the margins here and there, but effectively you can just move it wherever you want. It's the most fungible item in the world. That's why it's money. Similarly, software, there's no friction, right? One person can write one piece of code. And a great example of that is Linux. Look at the Linux operating system. Today, the most popular operating system in the world runs on billions of devices, was written by one person.
Yeah.
Right. And he wrote it as a summer project. And what a dramatic impact that has had over the last 2 decades in terms of the evolution of software. So software has this wonderful property. One person, two people, or as I like to say it, a two pizza team, a team that can be fed with two pizzas, is enough to change the world.
I love that. And you have worked in a fund before, and now you started your own fund here. And I remember when we were chatting, you just finished your fundraising for your second fund, and your first fund was oversubscribed. You started as a $25 million fund. It ended up as a $32 million fund, and you have blue chip, all LPs. So it's like institutional investors, endowment funds, foundations, fund of funds, and you have someone like Steve Blank, who is the GGV Capital founding partner, Scott Bondman, InBuddy Capital founder, Mukesh Patel, and obviously the late Catherine Gold. And having such amazing investors and LPs backing you, and how do you feel when you came for your second fund and you raised this money? Do you feel there has been a change, especially systematically I'm talking about? Do you think there's a systemic changes that has been brought into the system, or do we need more changes to see more capital deployment for diverse GPs like us?
I'm extremely proud of my LPs. Obviously, as you said, these are blue chip organizations, endowments, foundations, who have chosen to back me. And I've been very lucky. I've actually just closed my third fund.
Sorry.
And I was also in Fund 3. So that's a beautiful place to be. But with all due respect, LPs don't make the fund, right? I mean, they give us capital. And of course, occasionally they give advice. And I'm very grateful that they have trusted me and backed me and supported me. But I have to go make engineering capital successful. And by the way, this is exactly what I tell my companies. They come to me and they say, well, if you give me money, it'll help me, I'll become successful, etc. Or I'll go get this big brand name person. Occasionally now they're putting me in that category, and sort of saying, sometimes, they're just trying to stoke my ego. But I think sometimes they genuinely believe that the brand of engineering capital, etc., will matter and it'll help them succeed. I always tell them it's on the margin. Okay. What makes an investor is a great company. What makes a company is not a great investor. With all due respect to Sequoia, which I think is a fabulous venture capital firm, Google is a great company, not because Sequoia invested in them. Sequoia is a great venture firm because they invested in Google. Right. So I always tell my portfolio companies that, I'm thrilled to work with you. I'm proud and honored that they have chosen me. In almost every case, when I invest in a company, they have multiple choices. They have offers from multiple firms, and they are making the hard choice of, who do they really want to partner with. and whose capital will matter to them the most. I always tell them, you can choose. It's important. It's a decision which you should approach with a lot of care. But at the end of the day, it is not going to be the difference between winning and losing. That's
Right.
rare.
Right.
That's rare.
Right. I love that answer, what you said, like we are who we are because of our entrepreneurs, and this amazing entrepreneurs chose us. Um, Obviously, it speaks volume about engineering capital. Now, when you're talking about these companies and they're choosing you, I would love to know a little bit on your investment theses. You know, your investment theses focus on infrastructure as a service, big data centers. So how do you create your investment theses around the risk profile adjustment? And I would also love to know your take, like considering like there's so much of uncertainties and volatility in the market, though it feels like it's changing right now. But do you think your investment thesis has to create a different risk profile adjustment, and has that changed over years?
The core of my investment thesis is focusing on technical insights in software. It's really nothing to do with infrastructure software or any particular type of software that people are developing. That just happens to be a very dynamic area of change right now in IT. And so I've made several investments in that space. But I also have several investments in machine learning and AI because that's a very dynamic area. I have investments in security because that's another dynamic area in IT. So really the areas don't matter to me so much. The core of my investment thesis is technical insights. And technical insights is a very simple concept that's actually quite hard to find in real life. And people sometimes confuse simple with easy. It's a simple concept, and here's how I define it. A technical insight is, if I told a good engineer what I was doing, they would not know how I was doing it. In other words, it was not obvious to them. So you couldn't just grab a smart engineer from Google or Facebook or Microsoft and they could just copy what you were doing. And the vast majority of software is actually in that second category. In other words, a good set of engineers could copy it if they wanted to do that.
Yeah.
And so that is not where there are technical insights. Now you have to be careful. You can still build fabulous companies without technical insights because software is still software. It still has this wonderful property of having no friction and great leverage. And so you can still have market insights, consumer insights. You can build great companies in other ways. I just happen to focus on those companies where there is technical risk, where there is a technical insight. And that's why I call it venture capital for engineers. You don't have to be an engineer for me to invest in you, but there's a high likelihood that you're an engineer because those are the people who tend to have technical insights.
Yeah.
That's where we tend to work. But I'm equal opportunity when it comes to sector. It really, you really have to follow the market. Market is dynamic, lots of change happening. And if tomorrow somebody called me up and they had a fabulous technical insight, which was capital efficient and had high growth in robotics or quantum computing or blockchain, or I would be open to any of those areas if they had what I would define as a true technical insight paired with a great business plan.
That's great. So coming from technical insights, I would love to know your take. And again, quoting you from Wall Street Journal, you said, typically your entrepreneurs are executives, as you said, like who understand how enterprise work. And they're young in their 30s. Obviously, they're not living in a frat house, throwing ideas on a wall. And I would love to know, like, when these kind of companies go public and you have experienced that, do you think with the current environment, how do you see the exit environment looks like for you?
Yeah, so firstly, just on the demographics of the founders, I actually have founders all the way from people who dropped out of school to start a company. So Harjot, who was the CEO of Netsil, literally dropped out of the PhD program to start the company and ended up, building a very nice business and selling
Yeah.
that in a very nice way to Nutanix. To people who are in their 30s or 40s, who have experience, who have come from industry. And there's lots of statistics that, this stereotype of the Silicon Valley startup of, a bunch of young men living in a frat house is really not true. The true companies are built by a much broader range of people demographically.
Exactly.
That's where really they come from. And so I keep an open mind to that. As a venture capitalist, my focus is to find the best investor, the best opportunity, the best entrepreneur, the best opportunity, and see if they will accept my capital. And that's really what I look for. And those demographics are pretty misleading. So be careful if, when you're looking for that.
Yeah.
I think in my portfolio today, you will see a pretty broad range. I have women CEOs, I have obviously men CEOs, I have very young, I have older. I mean, I've got the broad range of people, all the different races, etc. if you look at it demographically. In terms of technical insights, they tend to come from people who have some form of experience. By definition, I am not an academician. I am not the government. I'm not a university. I'm not doing this as a charity. I'm not doing this to advance the state of the art. I'm doing this to make money. In other words, there has to be a practical application for the problem in the near term. It doesn't have to be tomorrow, but it has to be a few months away or maybe a year away. It's not 10 years away, because that's outside the scope of an investment that I would make. So it has to be pretty near term, which means whoever this entrepreneur is, he or she has to have some information about how the market is working, where the problem can be applied very near term. And those tend to be people from industry. But again, I've invested in people straight out of school. I've invested in a professor who dropped out of Harvard, robust intelligence, your own. I'm very proud and very happy. I met him when he was still at Harvard. Some of his students are the co-founders of the company. And then, company grew very nicely. Sequoia Capital followed me in the investment. And now we are solving the problem of data contamination in AI. So artificial intelligence suffers from this problem of data contamination, which nobody has worked on. We have some of the world's leading researchers. We have some of the best technologies. We haven't quite shared exactly what we are building yet, so I'm not going to break any news here on that, except to say that stay tuned. It is a fascinating company which has solved a very critical problem in artificial intelligence.
Wow. I think that gets me highly pumped up, especially on the companies you're talking about. Would love to know, following up, like, what are the exit environment do you think that currently looks like? Like, do you think there will be more IPOs happening or more M&As? Because obviously there's money in the private market and we are seeing a lot of SPACs happening. So would love to know your take on that.
Yeah, the exit environment is still large in terms of we are seeing very large companies being created, obviously exits for large amounts being created. I mean, SignalFx, my company was acquired for $1 billion. And, that's quote unquote, not news anymore. It's quote, just $1 billion. I mean, $1 billion is a lot of money, especially when you start out very early as an investor. But, it just feels like in the vast amount of wealth that is being created in Silicon Valley or broadly in technology, it feels small relative to those numbers.
Yep.
So in that sense, it's very good. Where I feel the exit environment is not good is that taking a company public is becoming harder and harder. Yeah. It is a sad reality that the total number of public companies listed in the US is going down, not up. Most people don't realize that. The Wilshire 5000 doesn't have 5,000 companies in it because we don't have 5,000 publicly traded companies to list in that, which is a really sad testimony to the functioning of our public markets. That is a political problem, a regulatory problem, a tax problem, a problem which really needs to be solved in Washington, DC and New York. And I really hope and wish that we will solve that problem, because it is healthier for us as VCs. It is healthier for us as citizens of America in terms of the stocks that I can invest in an IPO or in my 401k or in my Schwab account, if we have more public companies. So it would be much better for venture. It would be much better for the world and for the country if we could do that. But unfortunately, we haven't. We have incented the system where more and more of the gains are becoming private. And it is only at the very late stages that you go public. Most IPOs, as you observed today, are SPACs, or they are private equity companies where, with all due respect to my private equity brethren, all the juice has already been taken out of the company by the time they take it public, right? I mean, let's remember, I mean, Microsoft, Amazon, I mean, these companies went public at hundreds of millions of dollars of market cap. And today we're talking $1 trillion, right? All of that wealth creation was shared by you and me in the public markets. Whoever wanted to participate, even if all you did was buy an S&P 500 index fund, you shared in that wealth creation. I mean, Uber went public at tens of billions of dollars. All of that wealth creation was privatized that occurred over there. So as an early stage VC, I would love to see that problem solved. Unfortunately, I'm not hopeful. I think it's low on the priority list of problems to be solved. On the other side, on the private acquisition, absolutely, it's fabulous. There are lots and lots of acquirers. We are dancing with elephants. There are multiple elephants. So, in my particular area, companies like Microsoft, Google, Facebook, Cisco, VMware, Oracle, et cetera, et cetera, they're all acquiring companies. And so if you build a real business, if you solve a real problem, you can be acquired. You can get a very healthy multiple.
That's so true. I was recently doing a research on this and understanding the importance of prospect theory and endowment effect, and how companies are going public, but there's a huge amount of money they're leaving on the table with initial underpricing, and they're not realizing there's a long-term underperformance that also plays an effect. And you just summed it up so well. I just love it. I would love to know, since we're talking about the companies and the gains, when you are a fund manager, you're talking to your LPs, there's always a question of what is a good expected return? And then there's always a discussion about, the function of the high multiples of your fund. So, and depending on the risk profile and the stage of the capital deployment. So how do you navigate those questions with your LPs when you're asking, like, this is what my expected return is versus this is what my multiples is in my fund?
Yeah, it's a tricky question, especially in venture capital, because returns are so far out.
Yeah.
They are so delayed. And the signal is so poor early in the venture cycle because of the J curve. In other words, you expect to see losses early on. So it's very hard to really tell what's going to happen. Secondly, most venture funds, their eventual return is determined by a single outlier. So it really doesn't matter what happened in the portfolio. It's that one company that's going to drive that massive return in your fund that's going to happen. And so it becomes a very subjective decision for LPs to make. Thankfully, I am not an LP and I don't have to make that decision. I've only been on the other side of the table. What I've tried to do is give them a straight bottoms up view of where I think the value creation is. This is how much I think this company can be worth. This is how much of the company I own. This is the ownership of that company. And hence, this is the implied return that can occur over there. That's a very simple framework that anyone can work on. Clearly, it's wrong in the sense that nobody can know how much you will own at exit, or no one will know what the company will be worth.
That's true.
But you can start building up confidence in what sort of a return will be generated over there. And then, of course, the magic for LPs, and I tell every fund manager this, is that even though you should not try to engineer your fund or run it because of this, is of course DPI, right? If you have early cash returns, that has a disproportionate impact psychologically, but also from a very measurable perspective on your IRR. And so I've been fortunate, I've had early exits, in my fund. But that's frankly a reflection of the macro environment more than any great strategic insight that I had or any magic that I did. No, that's not really what it is. That's just a stochastic element of what's going on in a random world out there. So LPs have the hard choice that they have to make with it. But I can also tell you that, now having been in venture for about a decade or over a decade, and having met with many LPs, different perspectives, good LPs will figure it out. They ask really interesting questions, and then later on, when I go for my walks and I reflect on the question and I think about it, and I can relate it to, that's really very insightful in terms of being able to tell what will happen long term, where the outcomes will come out over here. Also remember, they're often not making a single fund decision. They're making a 2 or 3 fund decision, right? They're making an investment in a manager. They expect to do that multiple times, and hopefully a many fund decision if they are going to, if the manager will do well and continue to grow. So I think that's something you'll have to ask LPs for the real answer. And when you know the secret, let me know. So it'll make my job much easier.
Yeah, I always ask them that what's the liquidity, because it's kind of true. There are a lot of LPs like Utah Retirement System, couple of like LPs like Plexo Capital and others. Obviously, we are having Cross Creek VC coming this week. There's definitely this amazing questions that needs to be answered. And I feel like the lockup period is always longer. It's like they want to invest in you for 10, 15, 20 years. So I definitely understand that. And I feel like the LPs are also looking for that gain and understanding that how the, the management fees get recycled. And I just want to ask you this question, since I'm talking about this. There's always this, and you said that if you have an early exit and how the gain is being distributed. So would love to know, like, what do you think about recycling a realized gain as opposed to the distribution? I mean, what's your thought on that?
Yeah, I'll answer that question in a second, mostly from the perspective of what LPs are looking for and what we promise them. But on the previous question, I'm reminded of an anecdote, which I think your listeners would enjoy. I was once sitting with David Swenson. This is the famous David Swenson from Yale, and who, full disclosure, is not an investor in my fund. And so I had the luxury of being able to ask him any question, right? I mean, I was sitting with him, and because there wasn't any kind of a professional relationship, I said, so David, tell me the truth. What do you really look for when you meet a venture, when you meet a VC manager, right? I mean, you've invested in so many different funds, very different styles, very different approaches, very different strategies who've done well. And you obviously have this amazing track record as an LP of having invested in them. And David, of course, in his incredibly taciturn, pithy style, goes quiet for several seconds, enough that I'm uncomfortable now. I'm like, oh my God, did I ask the wrong question? Or is it rude for me to have said this to him or something? And then he looks at me and he says, consistency. I look for internal consistency. There's no right or wrong. There are GPs who are very public, who do a lot on Twitter and make a lot of noise, and there's a lot of PR and a lot of, thing going on. And there are GPs who you never hear of.
Yeah.
And they can both have amazing returns. Both styles can work. What I look for as an LP is consistency in the way they describe their firm, their strategy, their partnership, their returns, the investments they made, the companies, etc. Does everything internally seem consistent? So that's certainly an insight that I think may help your GP listeners as they are evaluating themselves in terms of, like, are we internally consistent? Are we doing what we say? Are we saying what we do? Are we practicing it in a way that it makes sense? Does our fund construction match our actual investments? Does it match what actual returns happen, et cetera, et cetera? So I thought it was an incredibly insightful answer encapsulated in one word by the incomparable David Swenson. And I'm sorry, I've forgotten the real question you had. Oh yes, recycling, of course. So, recycling is a necessary evil, given that we run 10-year fund cycles, we charge fees up front. And if you want to be 100% invested, you have to recycle to get to 100% cost basis. If someone is not familiar with recycling, the basic idea is, you raise, let's say, $100 million fund, 20% of that, roughly speaking, in a typical venture fund will go into fees. So you only really have $80 million to invest. Now, what happens to the other 20 million? There are a few different ways people think about it. There are some LPs who will say, well, in effect, I'm just paying you a higher fee because it's really being calculated on 80 million of true invested capital, not 100. There are others who will recycle, which is the classical traditional way, where they will take some of the early returns of cash and reinvest that in the portfolio so that the cost basis gets to 100 million. And then, of course, to stop bad behavior, we have to then put a cap on the other end and say you don't recycle more than typically 120 or 125%, because you don't want to become an evergreen fund, right? The LPs don't want to give you the money forever either.
Right.
So recycling is just a mechanical technique that is used to bring in line the fact that the fees get charged early on and are not returned into the fund. If you ran a fund with very low fees, I think you could probably get away from recycling. But I think most classic traditional firms do some form of recycling. That's just how the funds are, mechanically run these days.
That's true. That's true. And very well said. I like what you said about the recycling factors. And I think there's always like this question about, I gained so much, but people don't understand when you're recycling, you're actually increasing the returns in your fund.
Yes.
So there's obviously this interesting understanding. And I cannot believe this is almost coming to an end, but I'm coming to not the last question, but the second last question. And I definitely want to ask you this question. And I wanted to ask you this question, I think, the very first day I met you. And I spoke to a lot of my VC friends who are GPs and about you, they are so honored that you are coming to SheVC, and we are all looking forward to this, and they're all looking forward to asking you this question. So the question is, what are the pros and cons of being a single GP? Because you're running an asset under management around $150 million. And do you think you're starting a movement of a lean fund?
Yeah, so solo GP is definitely a trade-off versus what is the dominant way of venture capital, which is of course run in partnerships. Partnerships can be very small, usually 3, 4, 5 people, or they can be very large, where you have tens or now sometimes approaching 100 investment professionals in a single firm. Obviously, the word partner is used very loosely. When you are 50 people working in an organization, there's clearly some form of hierarchy over there, and they are clearly working on different parts of the area. Here's how you can think of being a solo GP in terms of the simple trade-offs. At one level, it gives you a great sense of freedom. You have a lot of independence. You can move quickly. You can make decisions. You can make controversial decisions very quickly. And often it's the controversial decisions which are more interesting. Of course, you can also make mistakes.
Yeah.
And so in some sense, a partnership has some form of averaging to the mean built in. That's the basic trade-off that you are making. The question is, which is better for you, why, and how are you going to run that? An element of personality comes in. There are some people who are more gregarious, who are more social, who need the thought partners, who like to make joint decisions. There are some people who are more self-confident, independent, iconoclastic, loners, etc., who are willing to make independent decisions. And so there's an element of personal style which comes in. The market has clearly accepted today that both styles can work. I mean, clearly I'm in the minority here. Many fewer solo GPs, but now some pretty well-established one. Tim Connors does it, Steve Anderson does it, I do it, obviously, Manu Kumar does it. I mean, so there's a bunch of us. In fact, we sometimes have lunch together, and we call it the solo GP lunch. I host a lunch for solo GPs. And if anyone else is out there who wants to start a solo GP firm, you want to join my lunch, please send me an email or a direct message, and I'll be happy to invite you. So we're a small community, but it does work. Here's the trade-off from the LP perspective. At one level, the best investment decisions are made by single individuals. I mean, Warren Buffett likes to talk about this. The best investment decisions are fundamental and contrarian. And so, you don't want an investment. You don't want a decision by committee. You really don't want that if you're going to break some rules. And so at that level, if you can identify an individual who can operate in an environment alone, from an LP perspective, you have a tremendous benefit that you don't pay what I call the partnership tax. Every partnership has a tax. Number one, most of their Mondays just go in administrative meetings, right? The partnership meeting. Number two, by definition, there are some partners who are better investors than others. They cannot all be equal. Therefore, you are investing in the average. You're going to get some better investments and some worse investments. I mean, that's just the nature of what you're doing. With the solo GP, you get a pure play. If you believe what I'm doing and if you like what you're doing, you know exactly what you're getting in terms of the investment decision as an LP with me. It's not being hidden behind, the opacity of a partnership. And then, of course, there are all the people dynamics. We've had some famous blow-ups in partnerships where, people have fought and there have been issues. I mean, we are human beings. Human beings have, political nature to them. And so sometimes these issues happen, and that comes with the territory. So there are trade-offs over here. There's no free lunch on either side. I do believe, as a bottom line, we will see a lot more solo GPs. It is a viable model. And it is a model which even, I would argue, has the potential to excel even more than a large partnership can. There's really no limit to what a solo GP can do, given the institutional infrastructure which exists now. So I certainly believe that I am in the vanguard, and there will be many more, whether I succeed or I fail, or however I may be known personally as an individual. But I think as a general trend, we will see many more solo GPs.
So true, because there are so many softwares that are empowering, the fund management, the legal, and various other structures. So I completely agree with you. And I always, cheer for solo GPs. So coming back to my last question, and again, this is the perfect question for a solo GP, is like, how do you manage the time diversification? when you're investing in a fund? How do you manage that? Because there are so many funds like you, they're investing in early stage and they're investing in later stage, and you're also doing a lot of follow-on ground. So what's your take on the time diversification?
Do you mean time diversification of the capital, or
Yes.
myself as an individual, where I'm spending my time as a human being?
No, on your capital.
On the capital.
Yeah.
On the capital, I don't have tremendous time diversification. So
Okay.
I am primarily a seed investor. I write large checks, large relative to my fund size and relative to me. Not, they are small relative to most other firms. But I will, if I make an investment, I'm all in. I do not, I'm a conviction investor. If I invest, I am all in. I'm willing to lead. I'm willing to do it alone. I'm willing to do it without waiting for other people, etc., which is how most of my investments have come about. And at that point, I've also deployed a significant chunk of my capital for that company. Now, I do have some reserves, and I do reserve some capital, and I do pro rata a little bit over there. But unlike a traditional firm, I am heavily weighted towards that first investment check, the first investment decision, and a little bit after that. Whereas if you look at the numbers of a traditional investment fund construction of a traditional firm, they may write a $5 million check into an A, followed by a 10 million into the B, a 25 million into the C, and maybe a 50 million into some sort of a growth stage, pre-IPO, et cetera, round. Well, now if you look at the cost average of that, all the cost came in that last 50 million round. I mean, that dwarfed everything which went before that. That's not true of what I'm trying to do. That's just a difference in strategy and fund construction.
That's true. And since you talked about time diversification, I just want to take a liberty of asking that, like, how do you manage as a solo GP? I mean, venture capital is such a, it's not a career, it's a lifestyle. Even in the weekends also, you're a VC, you're looking at deals or reading something about some of the verticals or particular research. So yeah, please talk about how are you managing that time?
I like to joke with my wife that venture is a great lifestyle business if you're a workaholic. So it works really well if you like to work all the time. I mean, reality is it's a very competitive industry.
Yeah.
It's a very competitive business. And, it's a services business. And so being responsive is very important. Being available to your CEOs is very important. I don't know at what time I'm going to get a call from my CEO. All my CEOs are on my speed dial. And they can call my cell phone directly. They know I will answer their phone. It doesn't matter what time they have an emergency, what time they have an issue, you have to be available to them. So short answer, you have to be a bit of a workaholic. That said, we have so much efficiency built in now into the way we work in venture capital. I mean, it's a mature industry now. There are models for doing it. I outsource my entire back office, so it's all taken care of. I'm really doing the high value work, the true work, which I have to personally be involved in. And I just tend to do it all the time. So that's just, I think that's just the nature of who I am, more than what the industry is. Different people practice it differently.
That's great.
And that I have, my Mondays are completely free. So.
Thanks a lot, Ashmeet, for your time. And we're so honored to have you.
It's been a pleasure. Thank you.
Thank you.